Good afternoon, everybody. Welcome to Investment Lesson with the Kendrick at Kendrick Tech Wealth and Purpose YouTube channel. So I want to reiterate on some things we spoke about last week. Um, Hopefully, I don't go over the time that I have allotted for today, but also want to go into more detail and give a few examples. I got another presentation with examples as well and some resources and tools I think will be useful for all of us going forward in our investment journey. So without further ado, go ahead and share my screen. Okay, hopefully everyone can see that. Okay, so today we're going to focus on research, allocation, and costs, and as well as accounts. First of all, I want to go through some of the different type of investment accounts that are out there for us as investors, especially here in America. I also want to talk about um, how you can take advantage of these accounts, which accounts would be right for you, which accounts are right for you, um, which accounts are not right for you, and also go into a bit of the cryptocurrency exchanges as well, and some of the ways we can leverage cryptocurrency as well in our investment portfolio. But first, I want to talk about 401k, and I want to make the difference between traditional and Roth known. So, for those of you that don't know, traditional is more along the lines of 401k or an IRA account, individual investment retirement account, that is typically used for those who make above a certain income threshold. Typically, those who make more than, I believe it's about $130,000, something along those lines. If you file taxes single, it's all based off of how you file taxes. Um, and then Roth, which is the other version of 401ks and IRAs. Usually, those are reserved for people who make less than that income threshold, which is uh, which is established or defined by the IRS here in the United States. So, what are the advantages and disadvantages of one versus the other, right? So, traditional, um, that allows you to invest in pretty much all of the same index funds, mutual funds, so on and so forth. Pretty much you get access to the same investment products, but you have to pay your taxes on the back end, right? So with a traditional 401k or a traditional IRA, I apologize, with traditional IRA, you have to pay the taxes on the back end, meaning when you start to withdraw money from these accounts, then you have to pay taxes at whatever your income level is at the time, right? Um, for those of us who are, which mostly is most Americans, including myself, who have access to Roth 401ks and Roth IRAs, we have the ability to pay taxes ahead of time. That way, our investments, our capital that we invest inside of those accounts grows tax free. So that when we reach the age of retirement or the age where we want to withdraw from these accounts and use that money as under an income, then we can use that money tax free, right? We can withdraw that money tax free, right? Now, the advantage to that is that, again, your money grows tax free. Um, Depending on whether or not you think that your income level is going to be lower at that point in your life, um, which for most of us it will be, then it's pretty advantageous to not pay the taxes ahead of time, right? Um, to not pay the taxes ahead of time. So for traditional, for those who make above a certain income threshold, them paying the taxes on the back end is it could be a disadvantage depending on what their income level is at that time when they reach that age of retirement. for retirement accounts like 401ks and IRAs, right? So, but there is also a loophole, like with many laws here, right? Um, that loophole for traditional IRAs is called what's called a backdoor IRA, right? That's where you're allowed to convert a traditional into a Roth IRA by taking a distribution and paying fees against that distribution, right? In the forms of usually like a check or something, right? And they just take that money, roll it over into a Roth 401k, which is usually a pretty simple process, and it's all taken care of for you by the company that manages that account for you. Also, moving on, I want to talk about individual brokerage accounts. Um, this is something that I use personally because like I said before last week, I'm on the journey called FIRE, uh, and I'm using the strategy to FIRE stands for Financial Independent Retire Early. So I'm using that strategy to um, build a portfolio inside of my individual brokerage account that I have with Webull. I'm allocating a certain amount of my income that I invest, of my earned income that I invest into my individual brokerage account because I have access to that account at any time that I want without penalty. The difference between individual brokerage account and 401ks or IRAs, whether they be traditional or Roth, is that you cannot access that money without penalty until you reach the age of retirement, right? Whatever the age of retirement is, or early retirement here in the United States, right? So I've known people who have withdrawn money from their 401ks or IRAs, and they paid a pretty hefty fine to be able to do that, right? I think it was upwards to like maybe 20+%, maybe closer to 30% penalty that they have to pay. So we see to take a withdraw money from their own account, right? With individual brokerage accounts, only thing I have to worry about is if I'm selling shares within that account, I just have to account for or that I have to pay taxes on those shares if I made a profit, which is called capital gains tax, right? If I take a loss, then obviously I don't have to pay taxes, right? Capital gains tax. And the fact that it's usually treated as if you can look at it kind of like it's a savings account or a checking account for the most part, but with the ability to um, buy shares of companies, ETF stocks, even crypto, so on and so forth. Um, Also, with cryptocurrency, I'm currently invested in Bitcoin and Ethereum personally. I don't really get into some of the altcoins. It's not really something I've been pursuing right at the moment, mostly because I just don't have the time to, uh, do the research on some of these plays that are out there, right? In terms of the altcoins. But either way, most of them, well, pretty much all of them still work the same in terms of the custody when it comes to private keys, right? So I'm not going to dive too deep into, the inner workings of how cryptocurrency, Bitcoin, blockchain technology, and all these things work today. I'll save that for another time or a different video. Um, but as far as custodying those private keys, which are basically, give you access to your cryptocurrency, um, there's basically three ways that I think that I highlighted on how you can maintain those keys. Actually, two ways. So whether you're using a central exchange or a decentralized exchange, which is very similar to buying stocks, similar to buying stocks in the stock market, like the New York Stock Exchange. When you purchase, you use fiat currency or capital to purchase exchange that in exchange for, say, Bitcoin, for example, on that exchange, whether it be centralized or decentralized. An example of a centralized exchange would be like Coinbase. I believe you can even buy cryptocurrency on applications like Robinhood, Webull, Cash App allows you to buy cryptocurrency as well. But and then there's also decentralized exchanges. And for those of us who understand Bitcoin at a more deeper level, you will understand, you will innately know why centralist exchanges are kind of oxymoron when it comes to cryptocurrency, or at least Bitcoin. But either way, you can open up account similar to opening up an individual brokerage account, similar to opening up a IRA account, and you can begin to purchase, deposit money into it and purchase whichever type of cryptocurrency or coin you like to invest in. Now, with that being said, the private keys for that cryptocurrency remains on the exchange in terms of when it comes to central exchanges. That's one thing I want to highlight. So there's a saying, not your keys, not your crypto, which is very true. Because if you allow your keys to remain on an exchange, then you essentially don't have access or custody of those keys, which means you don't have access or custody of your access or control or custody of your cryptocurrency, right? And again, if you understand Bitcoin, at a deeper level or even a surface level, you understand how much of a problem that can be, right? With that being said, there's always ways to, transfer that private key or private keys onto what's called a hot wallet, and then also what's called a cold storage wallet, right? So those are two options as well, where you can self-custody those keys and make sure that you maintain control and only have access to it. So I want to share my screen again. Share a different screen actually. Promise I'm gonna keep this, with that time frame today. That's my goal. So I want to touch on the contribution limit for 401ks and IRAs again. I got my screen up, the IRS.gov website that has the 2025 contribution limits for IRAs. So for 401ks. So for 401ks, 403bs, government 457 plans, federal government thrift saving plan increased. The contribution limit increased to $23,500, which is up from $23,000 from 2024, right? So basically, all that means is that for the tax year that we're in, like currently we're in 2025, this tax year, when we file taxes next year in 2026 during tax season, there's a form that you have to submit along with your taxes that shows how much you contributed to your retirement account. Usually, if it's 401k, you can get it from your employer, along with your, the other tax form that you get when you file taxes or individual income taxes. And then also for the IRA, the contribution, remember, the contribution limit remains at 7,000, which is, I believe it's the same from last year, right? As you can see here. Now, they did put out a Secure 2.0 Act back in 2022, as you can see in the article here, which increased the contribution limit for individuals 50 and older. So which basically means if you're 50 years and up, you can contribute an extra $1,000 more, right? Than anyone that's under the age of 50, right? And that's what's called a catch-up contribution, right? Now for 401ks, but that's only for the IRA, right? And I think the means is for annual cost of living adjustment, which is the same from for 2025. But for people 50 and over for 401ks, I believe there's a catch up as well. Generally, 50 and older can contribute up to $31,000 each year starting in 2025. Under a change made in Secure 2.0, a higher catch-up contribution limit applies for employees aged 60, 61, 63, or 62 and 63 who participate in these plans, right? So basically, people that are knocking on the age of retirement, right? Which is a good thing because it allows people who may have started late in their investment journey to contribute a little bit more. Now, me personally, um, the longer you wait, the less opportunity you have to take advantage of compounding interest, which is also known as the seventh wonder of the world. And but the earlier you start, obviously the better. So these catch-up contributions are something that our government takes into account for those who may have started later, right? Now, also want to go. I think I have an article here about Tony Robbins, who had something to say about 401ks that I thought was pretty interesting that I came across this week. For those of you who don't know, Tony Robbins is a very popular public motivational speaker. He's also a you know record selling record selling author as well. But he had to chime in. He chimed in on basically the cost of living and what 401ks um, face currently today and in the future in terms of um, their effectiveness, right? And basically, I'm not going to read through the whole article. I'll provide a link for those who want to read it on their own. But basically, what he was getting to was that he gave a few examples of three different individuals that had retirement accounts, and one was being charged a fee of 1%. The other one was being charged a fee of 2%, and the third person was being charged a fee of 3%. Right. So basically, um, the higher percentage that you're being charged, which is normally called an asset management. Trying to find this particular part in the article. Here it is, which is basically called an asset management fee, which is more usually something that you pay when you have a 401k and you're invested in a mutual fund. Um, but the difference between the person that he gave in the example who had an annual fee of 1% versus the person that had a 3% annual fee was absolutely staggering, right? Um, Basically, the employee that was paying 1% actually doubled their retirement savings of the person that the employee three who was paying 3% in annual fees for their mutual fund that they were investing in their 401k account. Now, it's funny that they have Dave Ramsey up there on the screen because he's a big proponent of 401k accounts. But I mean, mutual funds in particular. And that's one of the reasons why I personally invest in ETFs inside of my individual brokerage account because I have more control over the costs. I have more control over um, what type of companies that I'm invested in, right? And I have more control over basically when that allocation changes, right? When allocation of the portfolio changes, right? But usually mutual funds and index funds as well inside of retirement accounts like 401k accounts and IRA accounts, it's pretty limited, right? That was the usual norm for those type of accounts. But currently today that is starting to change because now you can invest in cryptocurrency, in particular, I believe Bitcoin in your IRA account. Um, you can invest in ETFs as well. So there are becoming more and more opportunities to or access to different types of assets or vehicles, investment vehicles that we can invest in inside of our retirement accounts as well, right? Um, and mostly, I want to focus on on how to research and what to invest in, right? So, what are we investing in? Why are we invested in it? Those are the two questions that you need to be asking yourself when you're investing, especially if you're just starting out from scratch. So, there's a lot of tools out there, which I'll show you here in a second. There's a lot of different tools that we can use like rating tools. There's also ETF research websites. I've created a few comparison tools of my own um, using Excel and some of the formulas that they have on there, just as a comparison tool. And then also for index funds and mutual funds. So I'm gonna show you some of the websites that I've used that have helped me in my investment journey understand what I'm invested in and why. So the first, going back to last week, Investopedia, which is one of the best tools out there to learn basically anything, right? Uh, you want to learn what an ETF is, what a mutual fund is, what a stock is, what a index fund is, what's the difference between all of them. They got you right here. Everything, FAQs, people who ask, similar questions and what you may have a question for, so on and so forth, right? You can get every bit of information you need from that. Also, another tool called Morningstar, just to show you how this works. You can basically type in any type of index fund, mutual fund, um, ETF, whatever, right? And you can pretty much get like an analysis for free on Morningstar.com, and it'll give them a rating, right? I usually use this for when I'm researching ETFs that I want to add to my portfolio, or if I need to remove them from my portfolio in my individual brokerage account, because I have a lot more control over that, right? Unlike the 401k and the IRA. But just to give an example, one of the ETFs that I'm invested in personally, you can see pretty much all of the information that you would find that you would want to know about this ETF all in one place, right? It gives you, the net asset value. Um, the things that I pay attention to is the total assets that's inside of this ETF, the company that runs it or manages it, which is State Street Investment. Um, and then also the expense ratio, right? So you can see the expense ratio here is well below 1%, right? And going back to what Tony Robbins said about mutual funds, some of those mutual funds, including one of the ones that I'm invested in with my company, in my 401k, Roth 401k, is, anywhere from 2+%, anything above 2%, you're losing a lot of money annually in your account, in your investment, your 401k account, because of those asset fees, right, or those annual fees, right, which are huge killers to the growth of your portfolio, right? Um, and that's why I really, really like ETFs, because you can get an ETF that just tracks the index, like the S&P SPY, or this one right here, this index, the S&P 500 growth, right? You can get something that tracks that index, right? And then you can just basically keep investing in it every time you get paid, which is also called dollar cost averaging, right? Every time you get paid, you buy shares of this ETF in your brokerage account, and then you just continue to buy consistently over 10+ year time frame, right? And also, I'll talk about that in a few. But this is where you can get a good picture of whether or not an ETF is worth investing in, right? Also, they get their own rating, 4 out of 5 stars for this ETF, so usually a good sign, right? Gives you the category breakdown, but what I mainly focus on is how much it costs, right? How much is already total assets already under management. $35 billion. I believe when I first got in, it was a lot less than $35 billion. Also, you can look at the value, the spread, things like that. Obviously, the price in the stock market, the range. Volume is more just like, how much of it is being traded on a day-to-day basis on the market, stock market, exchange. And, you get a summary, of what the ETF is about. It gives you like, past performance numbers as well, in terms of what the price was, the NAV, um, you know, the category it's in, like has it changed over the past since 2015, over the past 10 years, it's 2025 now. And you can see, you get a snapshot of the actual holdings as well. And then you can get a snapshot of the weight of the holdings, right? So with ETFs, just to reiterate that, ETF is basically like a jar of jelly beans, right? So think of it as a mix between a stock and an index fund. Um, it's closer to a stock because you can trade it. You can trade in and out of it in the same day as much as you want, similar to stocks, people who day trade. And it's closer to it favors or similar characteristics of an index fund because it tracks an index, one, and two, it's already diversified, right? It's already diversified because you're investing in multiple different shares, right, within that one ETF, right, that one exchange traded fund, right. So you're already diversified when you invest in an ETF like SPYG, right, which focuses on companies that are more growth minded, right? And I'll get into the difference between growth versus value investing and so on and so forth later at a different time. But you can get a lot of information here. Also, another place that I like to go to is ETF.com. This is a place where I like to go through and and you know search different ETFs that I'm interested in investing in. And obviously they have a lot of newsletters and stuff. Again, you can search in the ETF that you're interested in based off the ticker symbol. That's the 4-digit letter I keep, putting in when I'm searching these things. And again, just like Morningstar, it gives you a rating. Obviously, you see it has a really good rating, A and 86. You get the price, other information that you can get any of these other websites as well. You get the price, the value, as you can see, pretty much about the same information you can get from Morningstar, right? But what I like about ETF.com is that it gives you more information for free that I personally am interested in, which are things like inflows and outflows, right? So this is something that I look at before I get into an ETF that shows me whether people are buying into this ETF over a time frame, as you can see here, or people are moving out of the ETF, right? Again, this is a long-term investment play. So we're talking at least a minimum of a year, right? On forward, like 5, 10-year, 20-year investment, right? Long-term investors like myself, right? So over the long term, you're not going to see as much people investing or moving out of this fund, right? Because most people who are invested in this fund are buying and holding, right? But with that being said, there's other information. You can see the holdings, different companies that it holds within here. You see the allocation of the ETF, right? NVIDIA is obviously at the top with 13.25% of the ETF being invested into NVIDIA shares, right? So the company that controls this ETF or manages this ETF, this exchange traded fund, which is State Street, they control the allocations. They track it based off of the index that it's tracking, right? Which is the S&P 500 growth index, right? So they try to mirror it as much as possible, which is why it's basically like a set it and forget it type of ETF. You don't have to worry about researching all 212 of these holdings or companies and trying to figure out what's the perfect mix of stocks or companies to invest in. You don't have to worry about looking at all of their balance sheets, seeing if a company's going broke, right? They're going bankrupt. Are they profitable? Are they not profitable? You don't have to worry about any of those types of things. Looking at technical analysis, so on and so forth with ETF investing, because it's already diversified for you. It's tracking an index. All you need to do is understand how, what is this fund for? What is it invested in? How much is it costing me to be invested in this fund, this ETF? And, what is the total makeup of my portfolio? Like, what are my goals? What am I trying to do, right? Am I trying to lean towards companies that are growth mindset, right? Meaning basically they just want to, make the company grow. We invest the money back into the company, profits that they make, or are you more a value investor, right? There's ETFs for that as well. But again, it's already diversified. So you're diversifying your risk out of the gate, right? Um, but that's another tool. Another tool I like to use is ETF Database. And then this website right here, ETFRC.com. This is just a tool that you can use to, compare different funds to each other, ETFs to each other to see if there's overlap between the two, right? So, for example, would you say SPY and QQQ as an example, right? So, if I wanted to pick between SPY and QQQ, right, and I wanted to invest my money in one of these, right? I'm sure, in my opinion, both are very, very, very good ETFs, right? Um, I can see the difference between the two in terms of the weight or how much they're invested in each individual, how many shares are they buying of each individual company that it's invested in, that this fund is invested in, right? So as you can see, obviously there's a you can see if there's an overlap, right? So if they're invested in some of the same companies, right? They have shares in some of the same companies, which obviously you can see if you buy QQQ or SPY, I mean, you're getting the same shares in Microsoft, Nvidia, Apple, Amazon, Meta, Berkshire Hathaway, Class B, JP Morgan Chase, Eli, Lilly and Company, and so on and so forth, right? And you can see the difference between the weights. So, for example, with Microsoft, the weight that the SPY ETF, the amount of money that they invest in this fund towards Microsoft stock is about 7% of the total ETF, right? But for QQQ, they're more of an 8.8%, right? So basically, they're pretty close, right? Almost a 2% difference, right? So buying the difference between buying SPY versus QQQ for someone who wants to be invested in, the top 500 companies in America, aka the S&P 500, it comes down to, okay, I mean, I'm buying the same shares at about the same weight, right? Which again, we go back to the explanation of the weighting in these ETFs. It's like a jar, right, of jelly beans, right? So each jelly bean represents a different company that jar or ETF is invested in, right? So some jelly beans are bigger than others, right? Some jelly beans are smaller than others, aka the weight of the jelly bean, right? All that means is, in simplified terms, is that if it's at 8% or 8.8% or 7% is invested in Microsoft shares, that means they're taking 7% of that fund and buying Microsoft shares, right? For that fund or that ETF, right? That's all that means. So, for those who still, go into, what's the difference between, an ETF that's heavy towards one company or another. I'll go into that at a later. So I'll go into that at a later date. The difference between opening up, well, not opening up. Excuse me. I'll go to that more at a different date about which, into more detail on which ETFs you should be invested in, and do you want ETFs that are more, heavier towards particular companies or types of companies. I'll get into that more at a later date. But for now, again, back to the analogy of the jar. in comparison to um, the ETF. The more the weight, the heavier the weight is, or higher the percentage of weight, the bigger the jelly bean is, right? And the more money from that fund or ETF is invested in that company, the more shares they buy for that company, right? So let's share my screen again. Okay, so now that we know, I hope everybody can see my screen, but now that we know, what tool we can use to learn about what we're investing in and why we're investing in it, which is important. Um, what we're investing in and why we're investing in it. I now want to go towards actual portfolio allocations, right? So portfolio allocation basically um, is how much percentage, think about a big pie chart, right? Big circle, right? How much of that circle do you want invested in a certain asset class, right? So if it's stocks and ETFs and index funds and mutual funds, then okay, how much do I want to put into my 401k, right? Let's say 25% of my portfolio I wanted in my 401k in a mutual fund, right? Another 25% I want in an index fund in my IRA, right? And my Roth IRA, right? Another 25% of that pie I want into my individual brokerage account because I want a bridge account where I want to retire early, fire, right? Fire movement. And then also 25% into cryptocurrency, right? So I want to put 25% into Bitcoin, Ethereum, altcoins, whatever, right? So that makes up my entire portfolio, right? Just to give an example of what a portfolio makeup looks like, right? Now that portfolio makeup is something that's going to be different for everyone, right? It's going to be different, and the reason why it's going to be different because of the three things that I have on the slideshow right here that I'm sharing. It's going to be different because of time horizon, right? It's going to be different because of risk assessment or risk tolerance. Um, it's going to be different because of the goals, right? What are the goals of the individual investor or group of investors, right? So everyone's time horizon is going to be different, right? We're different ages. Uh, some, as you can see before, the catch-up rate for people that are 50 plus at 401k accounts and people that are 60, 61, 62, 63 that we talked about on the irs.gov website, the article. It's different for people that are older, right? Because they're closer to the age of retirement than someone like myself, right? So their time horizon to be able to start using that money to use it as income or withdraw from those retirement accounts or those investment accounts is a lot shorter than mine, right? So, that's the difference between a time horizon that you take into account when you're thinking about your portfolio allocation, right? So a time horizon. Someone like myself, I have several decades before I reach the age of retirement, right, here in the United States, right? So I believe it's like 67 or something for people born after 1970 something, right? Um, Risk assessment or risk tolerance, right? Now, risk tolerance and risk assessment is how much are you willing to, risk in terms of your capital that you're investing, right? So similar to gambling, right? Again, like I was talking about last week, gambling. If you're betting on, the team that is favored to win the game, then the payout is lower, right? Because they're supposed to win, they're favored. But the risk of losing your money that you gambled, right, that you put on the table, is a lot less, a lot lower, right? Versus if you gamble on the underdog, the team that's not supposed to win the game, that are unfavored, right? Then the payout is higher, right? Payout is higher, but the risk is also higher as well, right? It's very similar to, I use that analogy to get you to understand risk assessment or risk tolerance when it comes to investing, right, versus gambling, right? Gambling, I mean, if you're a person that can stomach losing, 100, 1,000, 10,000, $20,000, and you can take that loss, then that means your risk tolerance is high, right? Maybe you're someone who makes a lot of money, right? Millions of dollars a year. So losing $10,000 really doesn't, hurt your pockets, right? It's really not gonna lose sleep over it, right? But if you're someone that makes $50,000 a year and you lose $10,000 in a gambling bet, you're probably gonna lose sleep over it, right? Probably gonna lose sleep over it, right? Same thing with investing, right? There's always a risk in investing, but there's different ways to deal with that risk, right? So for people, like I said, your time horizon. If you have a time horizon that is longer, meaning that you have a while before you need this money that you're investing, right? You don't have to withdraw or take from it. Then you have a longer time horizon, right? Before you're ready to start using that money. Allow that investment to grow over time, right? So your time horizon is longer, meaning you have time to make up for the ups and downs of the stock market, for example, or the ups and downs of Bitcoin price, right? Or Ethereum or any of the altcoins, right? You have time to make up for those losses, right? Before you reach your time horizon. So your risk tolerance is usually higher, right? In that regard, right? Now, for people that are closer to retirement or older or more seasoned, they may not have the same level of risk tolerance because they need that money sooner than later, right? Um, that's why most of these target date funds that you see in mutual funds, the reason why they charge so much for the most part is because of because they are actively managed, right? So there are fund managers that are actively rearranging that mutual fund around in terms of what they're invested in, what money is invested in, right? For the people that own the ETFs, like people like you and I, right? That's why they charge these annual fees because they're actively trading in and trading out of shares for that fund, that mutual fund or that index fund. So it's actively managed, right? They have to do all the research on which companies to invest in. They have to do the research on, okay, this is the target date fund. So that means you're going to retire in 10 years. We need to start moving your money over to bonds, right? US bonds, and get out of most of these stocks that you're currently invested in, right? In this mutual fund, right? So that's an example of a fund manager that manages like a mutual fund in a 401k or index fund in an IRA. They're actively thinking about that time horizon and that risk for you, right? So they're doing that on your behalf. Me personally, I have almost half of my portfolio, maybe about 40% of my portfolio invested outside of my Roth IRA and my Roth 401k because I want to retire early. Not necessarily that I want to stop working early. It's just I want to be able to have access to that money earlier, right? So that's me personally why my portfolio allocation is different, right? From which would be the case for most people, right? But other than what would be the case for most people. No, and again, the reason why I do that is because I want access to those funds, that income earlier, right? Earlier. So my risk tolerance has grown. Just to give you a story, when I first started investing back in 2020, like heavily investing on my own behalf, right? Um, I used to check, the app, Webull app, the stock market app on my iPhone, like constantly check it. Like, I mean, I used to check it like when the stock market rose, I was checking it like every half an hour, when I had time, um, when I wasn't working, right? During times where I didn't have a lot of work to do, right, at work or whatever, or at home, right? And I will tell you, the more seasoned you become as an investor, the more you invest over time, from my own personal experience, the more you invest, the more time you spend investing, the more time you spend learning about what you're investing in, right? And the more time, you get used to the ups and downs, the swings, you know, you know, the market going up, the market crashing, so on and so forth, the more tolerance you build, right? So now it's gotten to the point where now I don't even check it. I make my investments at the percentages that I've already allocated, my portfolio allocation, right? Allocation. My company, they put in, take out of my check and put into my 401k, and then they match it at 6% on my behalf automatically. And then I put money into my Roth IRA, the same as I do my individual Webull, and I buy Bitcoin and move my keys off the exchange, right? And whatever percentage of my income that I've already allowed it to do it, right? And I'll get into more on how to tailor that portfolio percentage later. But I set it and I forget it because I'm a long-term investor. I don't need this money until 10 years from now. I'm not even trying to see any of this money until 10 years from now, right? Minimum 10 years, right? I'm already 5, 6, 7 years in already, right? So in terms of my retirement account, right? But in my individual brokerage account and what I'm invested in Bitcoin, and if I plan to buy a real estate, which is another asset class that I'll get into later at a different date, those I want to reap the benefits of sooner than later, right? That's why I have my portfolio set up there, right? So going back to the resources that I had here, um, just to give a better breakdown of like what ETF is before I wrap up here, um, and what an index fund is, like the differences between them. I just give you like a quick synopsis, which you can obviously go and read this article on your own, right? But basically, like to highlight the key takeaways, like I said, the analogy of the jar with the jelly beans in it. That's what I think about ETF when I think about exchange traded funds. So ETF is an exchange traded fund. Is a basket of securities, right? That's what the SEC defines it as, securities, a security that trades on an exchange just like a stock, right? The ETF share prices fluctuate throughout the trading day, unlike mutual funds, right? Which only trade once a day, again, a day after the market closes, right? So again, going back to what I was saying, so it's kind of like the child, like a mutual fund slash index fund, and a stock had a child, right? That's basically what an ETF is, right? But ETFs offer, low expense ratio, which I pointed out earlier, on Morningstar.com, and then on the SP ETF.com. You can see that the expense ratios are a lot lower, right? And there are fewer brokerage commissions, which I don't even think Webull, which I have my my individual brokerage account on, even charge commissions. I can't speak for Robinhood because I've never invested in Robinhood. But I don't think I think there are zero commissions at all in terms of buying ETFs on the Webull app, right? Or Webull.com. So, but yeah, basically, again, it's a fund, that tracks an index usually. And here you can see the differences between, index exchange funds, mutual funds, and stocks, right? Um, and like how they get the price, right? I was talking about net asset value, right? Um, how they're traded, how they can be bought. It's pretty much simpler. You can buy it on a regular stock market. It's like a stock, right? Or a mutual fund, so on and so forth. Um, and then also you can see the fees are lower. So that's one of the pros that you get with ETFs versus mutual funds, right? And just out of curiosity, I want to see what the annual what the annual fee is for some of these mutual funds. And that information is pretty much public. mistaken. Pretty much can find that information right here on the website. Yeah, here we go. So you can see some of these mutual funds offered by Empower Investments, which is the institution that my company that I work for uses. I include. But you can see that obviously these expense ratios are a lot higher uh, than the 0.04% that we were getting with SPYG, right? Or even SPY, I think is lower as well, a little bit above 0.04%, right? So we're getting up into the 1%, 1.16% for, this is the ticker symbol here, MXAPX, right? And but you're seeing if you look at the 10-year, since its inception, what the return was, the rate of return or return on investment was for this particular index, mutual fund, which has been open since 1999, September 16. So it's been open since basically Y2K, right before Y2K, stock market crash in 2000. And it's seen the stock market crash in 2008 as well, real estate crash, and a great recession. So over the past 2 decades or 2.5 decades, you get about a 7.95% return, right? Which is not bad, right? Before taxes and before you take into account inflation and so on and so forth, right? But you can see the rating for it is for the type of fund it is, just based off the name, it's an aggressive allocation. I don't know if it tells what aggressive means, probably does. Yeah, so basically, U.S. Domiciled aggressive allocation funds over the following time periods, 111 funds in the last 3 years, 95 funds in the last 5 years, and 77 funds in the last 10 years. This is based on the Morningstar's data, the number of distinct portfolio in a category with 3, 5, and 10 years worth of performance returns, respectively. One portfolio may have multiple share classes. Okay, yeah, it's not giving us an explanation of what this is. But to me, based off the name, and obviously the target date funds are funds that are targeting like a retirement year, right? So that's why they're mostly inside of retirement accounts like 401ks, traditional and Roth, right? So because they automatically reallocate the portfolio with inside this fund, right? So earlier in your life, they invest most of it in stocks, right? And then as you get closer towards that target date, like this one's 2030. So for people retire within the next 5 or so years, most of the allocation of this mutual fund is actually going to be more towards bonds and cash and safer investments that are less risky than individual stocks, right? So to preserve that portfolio balance and what you have currently invested, right, including profits, right, and dividends. So as you can see, 6.85%. I mean, there's not many, and obviously these are different types of mutual funds, so they're not invested in the same things. But it's not many in a 10-year time span, a 10-year range that gets you anywhere close to 10%, right? There's a couple on here that might get you 11.69%, but it's heavily invested in large cap companies only in the United States, right? Is what I'm saying based off the name, right? So you're not even invested in, probably not even getting a huge investment in foreign stocks like this one right here, which is needed for diversification, right? You want to be invested in companies outside of the United States as well, because you don't want to have all your eggs in one basket in all United States companies, right? U.S. companies, which kind of hard to tell which companies are actually U.S. companies, right? Because a lot of these companies are multinational companies anyway. So they operate in multiple countries or nations. But So the last thing I want to talk about is just something that I've used in the past to kind of give yourself an idea of where you're heading um, based off your current portfolio, right? Or what you're currently invested in. I will say when I was first um, putting together my portfolio, I read a book or two, um, searched a ton of different websites and forums and stuff like the ones I'm showing you here to kind of get an idea of what I wanted to invest in and why I wanted to invest in it, right? And so, but this right here again, this is a Dave Ramsey product, RamseySolutions.com. He has an investment calculator. There are other investment calculators out there too, or this one in particular is called retirement calculator. There are other calculators out there as well that you can use to kind of see what the return would be for, your portfolio, depending on how much you have invested already, right? And how much you want to contribute to your investment portfolio, like when you get paid um, across all platforms, right? Um, and which is also known as dollar cost averaging, right? And then you can also put in something. But I'm going to give you an example of how to use this, right? He gives you some explanation on what he recommends as well, right? So they recommend that you invest 15% of your paycheck, right? So every time you get paid, pull out your calculator. What is 15% of that paycheck after your taxes and stuff have been taken on? Obviously, when you look at your pay stubs. Or if you're self-employed, take 15% of whatever you pay yourself, right, as an employee of your company. And then you take 15% of that and you'll, plug that number in here, right? What do you think the annual return is going to be? That's a very difficult one to guess, right? Because you can't predict the future. But over the last 30 years, historically, the S&P 500 has been roughly 10 to 12%, right? So if you wanted to be more on the safe side, put 10%. Let's say you make, let's say you make, we'll just say $50,000 per year. Well, actually, let's say 60,000. That's the average household income in America. 60,000. I like to, invest the percentage of how much I make, right? Um, before taxes, so my gross income. So I would just use 60,000, you know, and 15% of that, and then put that in as the monthly contribution, which is $750, right? So we'll just say starting age, we'll just say a random age of like, we'll just say someone they just started investing and they started at 25. Actually, we'll say they started at 24. Average age of retirement, people born after 1960 to 67. I think it might be older now. They change it. But and then how much you're starting with. We'll just say someone just started, they got $10,000, invested into their 401k at their job or something, right? And then you can hit the calculate button and you can see, in 43 years, your investment could be worth, this is the max number, $7,149,827, right? So, and it gives you a breakdown. There's some options to use or resources, but there's a breakdown that shows you, okay, at age 24, you started with $10,000 invested, right? And your balance, right? And you contributed over the course of 43 years, you contributed a total of $387,000, right? At $750 a month, right? But 94% of this $7.1 million is actually growth, right? That's how much it grew to at a 10% rate, right? Rate of return, right? So if the market, if your investment portfolio, whatever you're invested in, right? Stocks, ETFs, crypto, and mutual fund, index fund, real estate, whatever, right? You kind of project whatever each of those asset classes are gonna get you in return, and whatever they're going to get you in return, and you can divide that number by however many different accounts you have or whatever investment accounts, and you can kind of get a number here, right? But you can see someone who has 43 years to invest, they only had to contribute 5% of that total portfolio, right? This is hypothetical, right? But if they get 10% on average, right? Some years it might be 5%, some years it might be 20% return, right? But it averages out to 10 per year, right? You're looking at, only 94% of that, majority of that, your investment portfolio is based off of growth, right? Being invested in the market, right? Now, versus someone who started at in the same position, $10,000 in their balance, they contribute $750 a year to make $60,000 a year, so 15% of their paycheck, or 15% of their total income, and they're getting 10% rate of return. Someone who started at let's just say 50, right? You're gonna see a massive difference, right? Now you can see the difference here. Someone at 50, even with the catch-up contributions for IRAs and 401ks, they only have time, 17 years, right, to contribute 153,000, but the growth of that is only get them to, 290,000 at $552, right? Which is 64% of their investment portfolio. But you see the difference is they had to invest 34%, right? They had to contribute 34% of capital, right, to their investments, right? Versus someone who's 25 or 24, they got 43 years to invest at the same rate of return, starting at the same amount up until the age of 67. They had 43 years to invest, and only about 5% of their investment was actual contribution, money that they had to go out, go to a job, work and earn, or they run a business, they're self-employed, they have to work and earn that money and contribute to this portfolio. So time horizon is a huge factor when it comes to investing, right? So, and there's a saying that time in the market always beats timing the market. So time in the market always beats timing the market, right? But but that's just to show you something that I wanted to talk about in terms of portfolio allocation, time horizon, risk assessment, and goals. So to wrap it all up, this is investment lessons with Kendrick Tech Wealth and Purpose, Kendrick Tech Wealth and Purpose YouTube channel, and this is me signing off. Thanks, and I hope to see you next week.